Hello, everyone. Michael Carlin here with your Capital Markets Outlook, joined as always, your friend and ours, Joe Taiber, our partner, our CIO, our guide, our guru. Good afternoon, Joe. How are you?
Great, Michael. Good to be here. Happy fall.
I know that's right. Happy fall. Yeah, for those of us, in Arizona, it has been a particularly brutal summer, and fall couldn't come fast enough. So here we are. Let's, you know, between the election and the market and the economy, we really have so much to dive into, Joe. I'm gonna make an effort to vacillate back and forth between the slide deck and bringing things to and fro. Again, as you're listening, I want to make sure to remind everyone, email me, contact us, call us, with questions, because I do realize that some of the stuff that Joe and I say, it's not always common investment speak. So let us know if you've got questions. If you need the slide deck, I'm happy to send the slide deck out. So stay in touch with us and let us know how we can better serve, help, and provide and guide you through this process, because there's a lot here. So with that, it's never too soon for us, Joe, to talk about the market decline. And I thought this was a really good place to start. This is one of the charts from Strategas that you had sent to me recently. And I just want to reiterate the strength, the magnitude, and the duration of that market sell-off that we had during COVID. It was amazing, but also subsequent to that, the move that we've had higher has also been amazing. And I think what's happening, if I could be so bold as to describe the attitudes and feelings of all of our clients, is general concern that it's too much, too fast, the economy isn't strong enough, their job market's not there, restaurants and the whole travel industry is still struggling. So how could this be? Because we saw the magnitude of that sell-off. We've now seen the subsequent rise of equal magnitude, if not greater. So, geez, Joe, it's hard for people to kind of wrap their head around that whole difficult situation.
Yeah, I mean, I'll tell you, how wouldn't it be hard to wrap your head around the largest contraction ever recorded in U.S. history that we experienced at the beginning of the year, followed by the largest and quickest quarterly expansion on record. And so that the markets mirrored that extraordinarily sharp contraction in the S&P 500, followed by a real sharp contraction in the a recovery in the S&P 500. Yeah. It actually makes decent sense when you think the economy actually is looking somewhat like the stock market. Difficult to wrap your head around, no question. Getting in front of itself, I think, is a whole nother conversation. Is the market really in front of itself? And that's where I think there's a lot more debate.
Yeah, and I think we're gonna unpack that. And as always, what we seek to do is we seek to grab the data, parse through the data, provide you the kind of that unbiased look at what's really going on, and then be able to make some conclusions from it. A couple of different slides. Let me shoot through them. World per capita GDP. So I think this is a really nice historical perspective, but the lowest world per capita GDP, COVID hit worldwide GDPs to an extent to which we haven't seen since World War II. So an epic and quick, sharp move down. At the same time, particularly for my retired clients, Joe, they're seeing the cost of their living, despite what the CPI inflation numbers are saying. And I know we have certain feelings about CPI versus PCE, but look here in the chart. I mean, the price of eggs, eggs from April to July up 28%, and lunch meat and bottled water. So a lot of the things that retired folks are using are going up. Obviously, the notable exceptions there would be travel and entertainment. Either they're not spending money there, or to the extent to which they are spending money there, the prices are very depressed. And as a result, Joe, I tie these three slides together, is that we're seeing that there's an inordinate amount of cash on the sidelines. The reason why I like this chart is that it shows retail money markets. And so you're seeing the amount of money that's sitting in retail money markets effectively earning zero at a level greater than where it was in 2008. I think it's important to note because, one, it shows where the mindset of the retail investor is. They're still worried. Two, they missed out on the rally, Joe. They missed out on the rally. Money was flooding out of the market into money market while the market was rising. So how do we reconcile this?
Yeah, I mean the age old fear of getting left behind
Yeah.
is very supportive. That last chart that you had up on the screen is a very supportive chart from here forward. So back to your initial kind of question, is the market in front of itself? I'd argue that probably not from that perspective. The backdrop of liquidity and the amount of money that still needs to find a home, a productive home, a returning home, is substantial. It's never, at record highs. So very encouraging actually from this point forward, just the liquidity backdrop for sure.
Yeah, it's the old contrarian view, but that's one that just tends to work and makes a lot of sense continually. Um, I hope I don't say this a lot, Joe, but I think this is one of the most important slides. For me, this is probably the most important slide, but let's
Okay.
just look at this slide. This slide, what it shows, Joe, to me is the green line is the trend line for wage growth, wage increases. The blue line is the real wages and real salaries. COVID hits, real wages, real salaries, where people are receiving in wages and salaries, goes down. The red line is inclusive of unemployment benefits. And when you add unemployment benefits to the existing wage picture, this shows to me exactly why consumer spending has been able to maintain its strength. It's continued to be strong, although the trend line, without any kind of additional government support, is starting to go back towards kind of this mean level, which is, again, not a lot of support from the government with additional dollars coming to support the unemployment insurance. So with that, Joe, how concerned should we be? Because we can see clearly now, oh, this is why wages were as good as they were because of the unemployment benefit. I can see it graphically. This supported consumer spending. I can see the trend that's coming. And I guess, Joe, maybe the better question is that if we don't get government support, are we really in the form of a bailout? Are we really in difficult spot here?
Yeah, yeah. I mean, this is a great chart because it paints the picture and it explains why we've had 5 consecutive months of retail sales growth. Why retail sales, which is a really good proxy for how healthy the pocketbook of the consumer is, why we're back not only above pre-COVID levels of retail sales, but this month, and the number just came out this morning for September, puts us back above where we were in January, coming in as if there was no COVID. So you had that big drop in the blue line. The stimulus more than made up for it, but it fell off on July 31st. Yeah. The debate right now, we think that's the biggest, and I know we're going to talk election in a little bit, but it is certainly, obviously, anybody who watches the news or reads anything, it's certainly probably the biggest contingency factor, we think, of the direction of the market from this point forward. Because if it's a continued stalemate, that's a big risk to the market. If it's an over strong delivery of stimulus, and again, that red line goes back up, that's very constructive for the market.
Right. I guess we have to wait, and there's nothing else to do for us to other than wait and see.
Right.
And as we're talking about this government intervention, we go back to the charts here, and what this chart shows is it just a nice refresher about the unprecedented policy response that we had, but not just here in the United States, Joe. As you know, it's across the world. And I look at it, this chart just throws it through June 20, from February through June. This is not fully inclusive of everything that was done, but just through June, 11.3 trillion injected into the worldwide economy. The 6.2 trillion that we injected, both again with the White House all the way through to the Fed, it was a grand total of 44% of our GDP. 44% of our GDP in that short pocket of time. It typically takes 9 to 12 months for that economic benefit to be felt. We're not through that cycle yet in terms of 9 to 12 months. And given the amount that has happened, and given the amount that is continued to be thought that's going to be happening soon with additional stimulus, and we don't even know the total impact, Joe, it is hard for me not to see continued economic surprises, given the fact that people are so negative on the stock market. They're so negative in so many different areas, but this liquidity injection is so supportive of the economy.
Yeah, and this is probably this back in March. You'll recall very well, Michael. Which is back in March. This was the number one driver of our view on the stock market.
Right.
Confidence in the response, both, and this is a great chart. This looks at central bank response or by the Fed, but it also looks at government or fiscal spending response. That total of the two of 9.5 trillion. Let's do the math on that. Most estimates for 2020 of economic contraction are about 5% for the full calendar year. 5% on a $20 trillion economy is about $1 trillion, right?
Oh, 5% on 20?
5% on 20, right?
Yes, right.
So,
Yep.
So $1 trillion contraction
Yep.
answered so far by north of $10 trillion in stimulus.
Right.
With another, what, 1.5 to 3 potentially coming down the pike. So
yeah.
So that is definitely, again, very, very conducive, probably to the next 12 months, assuming they get a deal done. But yeah, this is the number one driver.
And I'm gonna breeze through a couple of these other charts, Joe, because I just want to again give historical perspective on what we've seen here. Look at the policy response here in red in 2020 versus where we were in the financial crisis. This is the fiscal policy response. Just, when you look at this in magnitude, the swiftness of it, B, the size of it, and you look at the monetary response here in 2008. So again, toggling back and forth, the 9 times the response, and certainly done quicker. And again, the same thing with the Fed balance sheet growth. That's about triple the response, also in a shorter time period as well. You're looking at massive amounts of support, which is absolutely supportive of the market. And we'll have to wait and see if we get more and what that would end up doing to continue to support the stock market. And if it, heaven forbid, it's able to change investor sentiment with all that cash on the sidelines, it may indicate that we are in for certainly better times ahead, which we'll talk a little bit more about. I thought this was interesting. I looked at, the different areas of our economy, and we know that the travel industry has been hit. And if you look at what the food services, the janitors, sales and retail, transport, the parts of the economy that were hit super hard, and the kind of support that they were getting with the CARES Act, goodness, Joe, I mean, thank goodness it was there. But unfortunately, given the fact that stimulus efforts run out, I'm a little concerned about those areas of the market and the economy holding up. Are there things that you read into this chart that you see that are different or more concerning?
No, I mean, well, there's two things. We collectively, as a country, funneled more money than 100% earnings replacement to these industries. Yeah. So again, very, very much poured stimulus. The fall off in July, on July 31st of those benefits, very concerning. I totally agree. Ultimately, politicians like to keep their jobs. So we are signing a very strong likelihood to additional stimulus. But at this point, it's definitely a post-election. It's looking, I shouldn't say definitely, but it's very much looking like a post-election, outcome.
Yeah. Again, I mean, there's just a lot. There's a lot to unpack there. So why don't we keep cycling forward? I'm going to go through a couple of different slides here, Joe, on economic data. And listen, we could do an hour on just these next couple of slides, but let's for the benefit of time, we'll find a way to work through them quick. This is the amount of debt. And I think that people have problems with the relative amount of debt and indebtedness that they see, because it is incredible. Certainly the amount of corporate debt gets a lot of press. The amount of government debt at about 27 trillion gets a lot of press. What I find interesting here, listen, every single chart I find interesting here. I'm seeing improvements in certain parts of household debt, which has been great. I don't see any kind of parabolic numbers here in household debt that give me any cause for alarm. And the amount of money that it takes to service the debt This is from the Congressional Budget Office. I find this interesting because interest rates are so low, Joe, that the cost to service this debt actually is projected to go down for the majority of this decade until it turns the corner at some part later on, and that gives us a little bit of time for us to figure out a plan forward. So for those people that are calling out for we have too much debt, the interest alone on what we're going to have to pay to continue to have that debt is going to be outrageous. It seems not so to be the case given just how low interest rates are, with a 2-year treasury at 14 basis points and a 10-year treasury at 70 something. And I've seen things like monthly retail sales, which you talked about. You've seen this rebound, and the numbers here continue to look better. And Joe, I'm seeing the same picture even from the global growth. The economy, the global economy continues to grow as well. So from a debt picture to what I'm seeing on the from the global economic recovery, each one of those pieces continues to look good. So for all the negative things that we've talked about, lots of this economic data looks very favorable to me.
Yeah, and a lot of it comes back to stimulus. So whether the U.S. economy, the trajectory of it, Asian economies are the chart that you have on the screen here, overwhelmingly driven by China, which is showing really, really strong credit and fiscal stimulus impulses, social financing, things of that sort. So China leading the way for emerging markets in Asia. And China is obviously the world's second largest economy, so it means something very much. And then Europe, Europe definitely is, I think, it just near term here experiencing a bit more of a COVID second, or some people would say third wave. So I think there's some concerns a little bit swirling here in Europe right now, but it too definitely rebounded, particularly on the manufacturing side, just like we did in the US, just like they did in China. So overall, the global growth pulse right now, we view as relatively constructive, more so on the manufacturing side than the services side. And that's because services in whole, and this is just logical or intuitive, they've been more impacted by COVID. It's somewhat intuitive from that perspective.
Yeah, and I think that's listen, that's what makes sense. It's just we're a service-based economy, so a lot of people get caught up in that. We have to do a little bit on the Facebook, Apple, Netflix, Amazon. We have to do a little note there, and it's important because just those few holdings have such a disproportionate impact on the indexes that people continue to get lulled to sleep. And one of the things that we collectively have done and employed is we employ the S&P 500 equal weight index, which was great timing. Thank goodness. That trade seems to be working out terrifically because there was such a disproportionate move in just the few very largest companies in the index, which I'll put the chart up here in a second just to show you. And there's so many areas of the market that haven't participated in this rally. It's really astonishing. But I think this chart tells me what I need to know. If you're looking at January 2015 all the way through to 2020, this is your Facebook, Apple, Netflix, Microsoft, Amazon, and Google. These are your FANMAG, and this move, just even from the COVID low, is even more exceptional. But you compare that to the S&P 500, and it's a world apart, Joe. Since 2015, those six companies have more than tripled. Where the market's done fine in its own right, and it's up a net aggregate, let's call it 50%. We just haven't seen the participation that's been broad. The question on many's mind is like, oh my, how much longer can this continue? Because I do understand that in the type of economy that we're moving to, when we have more Teams meetings, more people staying at home, favoring Netflix, again, they first favoring Microsoft, again, Google and Apple and even Facebook, all those things work well with stay at home. They all work well with technology. They all seem very invincible. So at some point, Joe, are we going to break this trend? Because it's been going on for quite some time.
Yeah, this market dynamic, and you said several things there. The concentration of the S&P 500 is the standard cap-weighted S&P 500, the published Vanguard index, which we've used obviously in your models since we started working together. the concentration is multi-decade highs. So you have to go actually all the way back to the 1950s when IBM was emerging to see this
Right.
level of top heaviness in the S&P 500. So
And
that
you
in
may
and of
want this
itself.
chart too, Joe, by the way. This may help you here.
Okay.
The
So
growth versus value indicator. I think this is what you're referring to. The degree
this
to
is where
which the growth is being favored.
absolutely, because the top heavy names in the S&P 500, the Facebooks, the Apples, the Amazons are definitely growth names, growth oriented names. Whereas the value oriented names, more cyclicals, industrials, materials, sectors like that are highly undervalued. This chart is phenomenal. I mean, it absolutely screams overbought growth and underbought or very cheap value to historic proportions even greater than the tech bubble back in 99.
Right.
So yes, extremely top heavy market. You know, COVID benefactors were Facebook and Amazon. We need to just think about that and remind ourselves of that. The valuations of those stocks also are something that had us a bit concerned. And you referenced, we moved your portfolios, Michael, into an equal weight S&P, which eliminates that top heavy nature. Still owns the stocks, but it owns everything the same percentage, 500 names divided by 500. So that eliminates that top heavy nature. And we did that back, I can't remember, late August timeframe. So those sorts of things. The technology, the big tech names from here forward, if there's a lot of air in the balloon, there's more likelihood of when the market becomes volatile for that air to come out of those pockets.
Right.
So it's sort of an intuitive. So if you see volatility forward looking in the market, which you and I are in sync that there's a potential for volatility, certainly, you need to be a little cautious with those bigger balloons that are holding more air. So backing away from those and diversifying your exposure, I think, is smart. I think, and again, we'll talk elections in a little bit, I'm sure, but there are definitely some political and tax policy concerns surrounding the big tech names as well that we'll
Yeah,
touch on a
you
bit.
know,
So,
and I can't wait, Joe. We have all different kinds of clients, but I do have a few clients that own big positions in just a couple of those companies, and they're feeling really good about themselves. Not that I wish ill on anyone, and I hope that everyone makes a ton of money that's listening in. We want to give good advice and guidance, and we're happy to help. But at some point, Joe, you got to diversify those holdings because man, they will not go up forever. Certainly the way that they have been. And Joe, it's time for the election special. It occurs to me right now we need music or graphics, but I just have a slide that says election special. It's time. So yeah, let's go ahead and do this. And some folks are just tuning in thinking this whole thing's going to be about the election. It's critically important that we understand where we are from a historical perspective to gain a greater understanding for what we can expect the market to do given a variety of different political outcomes. So this goes without saying, but I'll mention it. I've mentioned it before. I'll mention it again. This is not about who to vote for. This isn't about a political stance. This is data-driven, economics-focused analysis. So this chart, as we're seeking to understand Trump's reelection likelihood, starts to shed light on some of the concerns that those who are in the Trump reelection campaign, who again, they're getting the data that doesn't look particularly favorable. We tend to look at PredictIt a lot, which as of this moment has them 16 points or so behind Biden. And when you look historically from Herbert Hoover on, again, when you get a high unemployment rates and you've got a recession that you're coming out of, you can go back since the Great Depression and you do not have presidents that are getting reelected. That just historically hasn't happened. And it doesn't necessarily mean, Gerald Ford or George H.W. Bush had solid stock market returns during their tenure. But given some of these other dynamics, Joe, this as a building block, and I think a foundational fulcrum piece of the data set doesn't bode well for Trump.
Yeah, I mean, I have a hard time, just like I did in 2016, to be honest, predicting anything other than from a POTUS standpoint, a Biden victory. I mean, the thing about there's a lot of differences between 2016 and today. Polling numbers are significantly more skewed to Biden than they were to Hillary Clinton. First of all, the volatility of her lead relative to the volatility of Biden's lead,
right,
hers was much higher. Trump had leads in polling in September, October. He's not been close. So I think that a lot of the focus on the presidential election is one thing, and certainly it's a big, we expect it to be a big director of or influencer of market returns. But our read is that it's actually the outcome of the Senate,
right,
that is arguably, and I'm sure we'll get there, that's more important actually than the outcome of the White House.
Yeah, we are going to unpack that, and we are going to unpack it. We need to, well, so let's there's a lot of variables, Joe, with regards to this election, and one of them I think is one of them I know is voter turnout. Impossible to know what we're going to see, what it's going to look like, but one of the data points that I saw that I thought was particularly interesting was here, and it showed that there were, in the swing states in particular, you're seeing those states that are being hit with a higher percentage of people that are applying for unemployment benefits. If it's a swing state and they're having a particularly difficult time in the job market just before an election, that's not great. If you look at where COVID cases are peaking, the way to look at this chart, it's a little bit like a Rorschach test. I don't know what object you see, Joe. Maybe you see a smiley face, which would tell me something about your personality. Maybe you don't. I don't know. Maybe if you see a frown, I don't know how you see that. But the point is that the way that this looks from an eye test perspective is that you can see here in red the places that Trump needs and wants to win, or won, I should say, in 2016. You're seeing a significant COVID presence there. That doesn't bode well either for the electoral process for Trump. I'll get to that in a second. Is there anything you want to add here, Joe? Yeah.
I would. I mean, the big picture here in the presidential election, Biden has roughly a 10-point lead, a blend of the betting markets and the polling averages nationally. Mm-hmm. Okay. About a 10-point lead nationally on average. He also has a 4-point lead in the swing states as well. So this is why, markets are assigning more odds to a Biden victory than a Trump victory. Turnout is something you just mentioned. I think that's something that's really, very important as well. 2018 midterms had the largest turnout since 1970. And I think a lot of the, think of it what you will, but the personality characteristics and the like of the president, I think drove a lot of things back in 2018. I'd expect something similar today. The one thing that we're already seeing, though, in terms of early voting is also remarkable. The state of Texas is already, and the state of Texas has very limited and restricted mail-in and early voting procedures. They're already 20% of the overall total that was voted back in 2016. Vermont is already at 35%. 1 out of 3 people have already voted. So there's some real significant kind of early voting running at about a 6 times normal clip. A lot of this, obviously, it's COVID related, but early voting is running at a 6x clip where it has historically, right now. So.
In the great unknown to me is obviously the reluctant Trump voter, or someone that doesn't want to vote. Again, someone doesn't want to vote for Trump but ends up doing it. And do you know what a reluctant Trump voter looks like? I actually have no idea. But the point is that no one knows what they look like. No one knows. We don't know. And we will have to find out. We'll have to find out. But I imagine, Joe, that there's a large number of folks out there, listeners or otherwise, that, are going to vote that way, but would never tell anybody or even admit to it. So we'll have to see.
Which is why we and you and anybody who's been watching politics for the last 4 years knows that whatever these polls say doesn't really mean anything.
I know.
That's very true. Hey, one other thing on the presidential election that I think is worth mentioning is this notion and possibility of a contested election.
Oh, we've got data on that for sure. Yeah, let's hit it.
Okay.
What do you want
Because
to?
I think
Yeah, no,
it's
we got to do. We're gonna do it.
doing
We got to do the contested elections. That's got a huge market impact, I think, which we can.
it absolutely does. I didn't see a chart on that, but I wanted to make sure. I don't know if you do have something you want to point to.
My favorite phrase is I've got a chart on that. That's like my catch line. I need a shirt that says I have a chart for that.
Of course you
No,
do.
I
Hey,
know. So no holiday gift ideas. I'll get my own. But
so
yeah,
one of the surveys we pay a lot of attention to actually is a Bank of America institutional money manager survey.
yeah,
And usually we just take away what their cash positioning is to see if it's elevated or low. They also ask questions about scenarios in base case scenarios. And it was a 62% of respondents, institutional money managers, by the way, 62% of respondents had a base case expectation of a contested election. So that's not an encouraging thing from a market perspective. That also would argue that the market has priced that in, however.
yes.
So,
Yeah, no, you're right. Well, certainly from the retail money market plus the B of A institutional survey added those two components together, and you've got something that makes that case, I think, really well. I wanted to talk a little bit about, very, very briefly, kind of, the political uncertainty that we're living in right now. Listen, I'm not going to soapbox any of this because again, all of this is done with a financial tilt, but let's just look at where we are now versus where we were. We were in a place 40 years ago. Again, this is starting the baby boom generation. Demographics were very much in our favor. We had falling interest rates coming off of very high inflation. We were just entering a real globalization period where the cost of goods and services were lowered or lowering sequentially as more businesses were doing additional manufacturing or services offshore to reduce the cost of what it is that they were producing. More automation, again, driving the cost of things down. That's where we were. The market looked great. We had a couple of really great decades. The fulcrum here is 2000. Again, that birth and explosion of the internet. And what it marked is that, rates have been getting, again, in a place where now we're at bottom of the barrel, low interest rates. Demographics are tougher in that we do have the millennials on one hand, but where the bulk of the money is still is with the baby boomers. So to some degree, we have demographics working against us in large concentration. And we have an anti-globalization and populist approach towards our economic system that is not conducive with rapid growth. And we've got lots of debt, which we covered earlier, both corporate, governmental, and even to some degrees on an individual side, although on the individual side, that level of debt looks very sustainable. But when you're dealing with these different sets of criteria versus where we were in the 80s, I don't want to conflate the two things because I have some people kind of hoping that we'll have a return to Reaganism in terms of where we will be economically. And it's tough. And as a result, we've got this high political uncertainty. So I think that what I want to let people know is that we're aware of the demographic changes and all the other sequential changes that we've talked about that have put our economy in a different position than we've been in decades. It's led to high political uncertainty as measured here. You can see where we, again, this is COVID, but we have super high political uncertainty, far more than we did in 2008. But what's nice is that even through and with all that political uncertainty and even with all those challenges, it looks like, Joe, that tends to lead to higher market returns. Mm-hmm. How do you put all that together?
Well, I mean, high policy uncertainty leads to market volatility. I mean, the peak of policy uncertainty was March of 2020.
Right.
And think of the March of 2020 through September, October of 2020 returns.
Yep.
Nosebleed returns. So yes, policy uncertainty correlates with market. Policy uncertainty correlates with market volatility, which correlates with attractive forward returns from that point forward. One thing I'll mention, I think that last slide you were on which is really important, and it plays into what you're doing from your investment program specifically. All those things, low rates, higher levels, particularly of government debt, declining demographics, and an anti-growth populism, anti-globalization movement. That is definitely an anti-growth cocktail. So all those things, what do they mean? And you know, we work with a lot of institutional clients, so pension funds, endowments, and the like. What this really means, it's not, those don't add up to a friendly environment from a secular perspective, a long-term perspective, for a simple 60-40 portfolio.
Right.
And the reason is that the 40% you have in bonds isn't yielding 5% like it was in normal times. It's yielding 1%. So you don't get contribution from fixed income. You have volatility and declining or deteriorating aspects, those other three boxes. So it does beg or make a case, I should say, for arguably some more tactical management of your program, of your investments and the likes, because it does not mean you can't do well, but it does make a pretty strong case that a buy and hold 60-40 approach might fall short of expectations. That's all.
Yeah, and in case you missed it, Joe just predicted the death of Vanguard. I'm joking. You didn't. You didn't.
Well,
but
I didn't say death of indexing. I said death
of using closet indexing. And so, right to your point, Joe, we make a concerted effort to have our portfolios focus on parts of the market that are working. We're looking for where the momentum is, where the opportunities are, and always trying to refresh the portfolio to capture value. Joe, did you see this morning the note on Chewy.com? Because one of the positions that we enacted it's probably 6 or 7 or 8 weeks ago, was that pet index. And we took a pretty significant position. It's actually one of our 25 largest holdings, by the way, and across our organization. And it's not that I'm not right. This is not a recommendation. So do not take this as a recommendation. This is not, so don't go out and buy it. But if you're our client, I'm just letting you know a little tidbit. But there was a really great note. Chewy was up about 5.5% today because they were acknowledging the fact that through COVID, pet ownership was spiking, but through, good quality, thoughtful research and forward thinking and continually having a portfolio that looks ahead, that's how we're able to do it. That's how we do what we do. And it's not just that 60-40 portfolio that's not moving. There's a lot of thought in it, and those kind of moves make a huge difference. So I thought I'd point that. All right, Joe shaking his head yes. He wants me to go on. All right. So I want to point out, there's too much to point out with the Biden presidency, but can we just do taxes for a second, Joe? People freak out about the taxes, and there are moments where I'm one of them. I'll be honest. You start to do the math in your head about what Biden is proposing, and then you look at it from a historical context here. The amount of tax increases that Biden's proposing, and he even said, Biden did last night in his own town hall, not debate, town hall discussion, was that we'll have to see what taxes he's going to be able to implement. But if Biden had his way, the total tax increase would be, as a percentage of GDP, seeks to be the second largest in our country's history, and just significantly larger than we've seen in many, many, many decades. And it's going to come in the form of higher corporate tax here in blue, higher payroll tax, higher small business tax, higher cap gains tax, and potentially something with a state tax carryover. So, we have to, I think, Joe, we need to acknowledge the fact that those higher taxes, particularly put on the lap of corporations, has to hurt their corporate profitability if it were to happen to some fairly significant degree. I think the question is that do those tax increases that are being proposed under a Biden administration, could they possibly be offset by additional government intervention, whether it be in the form of additional stimulus or infrastructure spending? And is that the right way to handicap this whole thing, Joe?
Yeah, well, that's what the market is market action, I think, is referring to right now. I think it's interesting. If you asked me a month and a half ago how the markets would be reacting to an increasing likelihood of a Biden win and a Democratic sweep, I would have said negatively. But I think the market really is starting to get its hands around and quantify. In fact, the last chart you had up does quantify it. That the overall tax package equates to about a 10% hit to earnings, corporate earnings. So you should expect roughly a 10, or this chart says 12% to after-tax income. That's 10% roughly to EBITDA. I mean, a 10% hit to corporate earnings, a negative. Increased regulation is probably a negative at the margin as well. I think much less so on the financials. Financials really aren't batting an eye relative to a Biden expectation, just because the financials have been living with Dodd-Frank for a decade already, and I think they're more at the margin regulations coming from that perspective. Healthcare regulation is something definitely that's on the radar. Some negative connotations from healthcare, but there is a positive side of the ledger with a Democratic sweep, which it seems the market is sinking its teeth into a little more so, certainly over the last 4 to 6 weeks, which are things like vastly improved trade relations with China, vastly reduced trade conflict expectations with Europe. So that stability is going to reduce uncertainty, number one. Number two is elimination of tariffs. The elimination of tariffs is a very positive thing that is expected under a Biden or a Democratic sweep scenario. And the last and overwhelmingly most important, we're beating the dead horse, is a D sweep likely translates to north of $3 trillion in fiscal stimulus, plus a $600 billion infrastructure package that is making markets very happy for the next 12 months. Longer term implications are a whole nother conversation. But that's what really I think market action is how it's pricing in the election outcome. So yes, tax is a big concern, but there's another side of the ledger.
Yeah, and the one thing, and you mentioned it, Joe, but I just wanted to kind of put a different lens on it a bit, and I don't think it gets enough discussion. Is what there's at least a high likelihood. I think the market believes it, and to me, it makes good fundamental sense that a Biden administration means that there's different relations with China, different, more positive relations with China. And in the amount of additional business that we would be able to secure with a strong relationship with China, and how many businesses that impacts. I think there's also another tailwind just specific to China alone. Again, better trade relations worldwide, but specific to China, I just think that there's some positive room to be made up right there. Couple of charts here just to show. I can breeze through these ones. Historically, neither party has had an edge. So the rate of return average is both 9% plus a little bit for both Republicans and Democrats. Those that are strong Republicans don't believe this chart. Those that are strong Democrats, they feel the glory that economically things do well. Where we discussed this earlier, and we're bringing it back to that briefly, is that divided government, and this is kind of that D sweep argument, divided government tends to be a higher performing stock market with an average rate of return of 10. In a unified government, the average rate of return of 8.2. That's a significant difference, especially to a 2% return differential over a 4-year period of time. That's meaningful. So is there any, I'm sure, is there more that you wanted to unpack with that?
One thing, historically, gridlock is good. That's what that last chart said. Historically, and it's very true. Of the various election outcome scenarios, the one that does have us a bit concerned actually is gridlock. And it's a form of a Biden White House, a Republican Senate blocking fiscal stimulus, potentially, which is what happened. And the reason I say that is because that's what happened back in 2011 when the Republicans took control of the Senate, made it very difficult for any sort of stimulative efforts really to get pushed through more fiscally conservative momentum back then. Now, the Republicans haven't been nearly as fiscally conservative, but there is definitely obviously more of a DNA for that in the Republican Party than the Democratic Party, certainly. So that is a risk. In fact, a bank credit analyst, one of the research engines we really look to, is forecasting only about a $500 billion stimulus package with a Democratic White House, Republican Senate, and that probably disappoints markets materially. So, yeah, that's worth mentioning.
Yeah, it's funny, but since when did 500 billion? It was like a 500 billion. That's all you got. It's interesting. What a difference a few years makes. So can speed through a couple of these very, very, very important charts. So Joe and I have continued to hit home the point that all this government spending is stimulative to the economy. It is also stimulative to the stock market. You can go back to 1930. This chart says it clear. When you're running a large deficit, the average rate of return of the market was running 15.2. When you have a surplus to a small deficit, not as much government spending, the rate of return of the market's less than half. It's less than half. I mean, so look no further than the fact that you can see, if you look at the CBO estimates, as I have here on the chart, you'll see that it looks to be continued significant government spending, which is also, again, to the previous chart's point, very beneficial and helpful to the stock market, which leads us to, one of the final points here, Joe, and that is the election chaos. This is the data. This is the moment where we talk about if we do have a contested election, what happens? And when we look from a historical context, if we do have legal challenges, which is kind of this baseline case here in yellow, you look back to the hanging Chad election in Florida in the year 2000, Gore versus Bush. And at that time, the market dropped about 11.5% in a 3-week period of time. So the base case is if there is no clear winner in November, what we're seeing as an expected rate of return is we're looking at maybe a -10 for the S&P 500, a -12 for the NASDAQ potentially. And on the flip side is that if the polling numbers and if the predicted numbers are accurate and you do get a clear, concise, decisive victory, in this case, it would likely, as the data indicates, to favored Biden, then the market may respond positively to that. Again, this is given historical context because there is this general sense of fear that it will be a contested election. And then if that indeed happens, you get that clean result. The expectation is the market rolling up 5 and the NASDAQ rolling up 7. So, I mean, of course, there's the bad case where there's the surprise on taxes. That data is here, Joe. I don't know if we need to go over it, but between the contested election or things being done on a very certain basis, I think we can look fairly reliably to the past to gain a greater sense for what we may be looking forward towards the future.
Yeah. I mean, it's a sit and wait. It's a sit and wait situation. November 3rd, November 4th, get a read for what the landscape looks like. And yeah, I mean, the thing about it though, I mean, any significant dip right at or shortly following the election, we'd likely, depending on the environment at the time, of course, but we'd likely view it as a buy the dip, depending on what the tea leaves look like. Because if we do see meaningful stimulus in 2021, is a high likelihood we will view a dip in November as a buying opportunity or a buy
absolutely.
So,
100%. I mean, and we try to buy dips as much as we can. We just, in general, and I'll probably close with something like that. Real briefly, Joe, this is not perfect for everyone. Do not copy and paste this information, and this is not blanket investment advice. Is that enough of a disclaimer? I hope so. If Trump were to win, there are some areas of the market that we would look at more favorably. With a Biden win, it's certainly going to be the thought about infrastructure spending. You're looking at building materials and construction. There are some areas of the market that we might seek to avoid with a Biden win. Again, we're going to have to wait and see how things shape up. But this is how we see things coming together right now as we sit here, just to give everyone an idea of the fact that, yes, we are aware that not all areas of the market are going to respond accordingly, which again folds into what we had discussed earlier with the fact that this is why kind of that closet indexing approach, we feel like in particular now more than ever doesn't really work well, since certain areas of the market are going to respond differently to the economic environment. But Joe, on a big picture, Roosevelt, Truman, Eisenhower, Carter, Bush, Obama, Trump, you name it, you got blues, you've got reds. The market does what the market does. I know we spent a lot of time on the election, and I know it has in impact on what we're doing, but the market still is fundamentally made up of company profits and companies doing well year after year and doing better. So I know that the election is going to have some impact and implications. I get that. But from an economic perspective, what people should look to us for is finding opportunities, keeping you invested, because red or blue, the economy moves on.
The economy moves on. The stock market tends to move onward and upward together. So that's where things go, irregardless of election outcomes. A lot of things to evaluate in portfolios that I know manage well, Michael. So I think that sums it up pretty well.
Yeah. Way longer than we wanted. I knew it would be. And so for those of you listening to this in two parts, thanks for making it all the way through. If you listen to it in one and you hear my voice, you stayed awake through the whole thing. This is an achievement. So well done. We should be giving out credits, like CE credits for this. This is like an economics class, a finance class, all rolled into one. Joe, you're amazing as always. Thank you so much for everything. If you guys have any questions, reach out, let us know. We're here. Email, call, whatever it might be. Don't follow my investment advice specifically in here. Don't be making trades based upon what I said without talking to me first. Another disclosure. Thanks again so much. Take care, everyone. Material on this program is intended for general information only and should not be taken as specific investment, tax, or legal advice. None of the information contained in this broadcast is intended by the host to be a solicitation for sale of any security. Further information is available by contacting Henry+Horne Wealth Management. Securities offered through Independent Financial Group, member of FINRA SIPC. Advisory services offered through Wealth Management LLC, DBA Henry+Horne Wealth Management, a registered investment advisor. Henry+Horne Wealth Management and IFG are separate and unrelated entities. Henry+Horne and Henry+Horne Wealth Management are separate entities. Member of FINRA and SIPC.